What's up, guys? So February's monthly candle just closed for the stock market, and I want to talk about it. There's definitely some implications with the monthly print going forward, so we want to focus in on that. Obviously, 2023 is off to a great start. We've locked in more gains than the Liver King. We have printed more dollars than the Federal Reserve, but we need to be careful because markets, much like my ex-girlfriend, be ready to turn on you on a dime. And while most of you are experienced in life, women, and investing, some of you are new to the game. And while you may not have the years under your belt, if you've been involved in these markets the last couple of years, you've definitely been baptized in the fire of destruction. And while only a few years in the markets have passed, I'm sure most of you have aged at least a decade. All right, so enough playing around. Let's take a look at the Dow Jones Industrial. So here we have the Dow Jones Industrial Average. This is the major U.S. index I like to use to gauge the overall strength of the markets. This and the S&P. But today we're going to focus on the Dow. So here on the daily chart, we saw obviously we peaked out and then had a vicious sell-off for the Rona dump. And then we proceeded to take out those highs and go into a very strong bull trend. If you were trading how I was and you traded the 200 exponential over simple cross, or when they flip bullish, you were basically involved in the markets back here at about 26,000. They then ran up to about 36,000, somewhere around there. Roughly 30+% increase just from that level. Unfortunately here, once we started to top, we started putting in lower highs, and we actually flipped the 200 exponential and simple moving average red, clearly confirming that we're going into a bear market. We essentially came back down and back tested that pre-Rona high, which is what you would expect essentially on the pullback, and that area held, at least for now. From then we moved to the upside and actually took out the previous lower high, which is a step in the right direction, although I'm not quite convinced yet. So if we just zoom in here a little bit and take a look at what's going on, we see multiple rejections on the 200 exponential and simple, and then finally we broke through here in November of 2022. At that point in time, we went on to take out that high, we back tested the 200 exponential, and we started to actually flip the 200 exponential and simple blue, the beginning of a potential bull market. So on the retest, we came up afterwards though, and we've done nothing but put in lower highs since then. And this is definitely starting to look more and more like a double top. As a matter of fact, it sort of looks like a double top within a double top. If this is our initial top and we have one peak, and then we have a sharp push up here and retracement, and then a rounded kind of peak as well, this is essentially an Adam peak and then an Eve double top right here. And then that is also a top. So we now have a double top within a double top. And now here we are threatening the neckline. Now this area is key support as it comes in line with the 200 exponential, the 200 simple, and we're currently fighting to maintain those levels. So honestly, at this point in time, the wick down from today has actually taken out the previous lows on the wick. So since we put in that high, we're currently putting in the lowest low. Now it's nothing to be too scared about just yet. The only issue is that normally what we're looking for is a series of higher highs and higher lows in an uptrend, or a series of lower highs and lower lows in a downtrend. So at this point in time, we now have a high, then a low, then we have a lower high, and now we're potentially getting ready to print, but at least wicking down and putting in a lower low. So taking out this level, not only as support for the neckline of the double top pattern, also the 200 exponential and simple, is potentially a compromising situation that likely leads to lower prices. So if we just grab our arrow tool and we just measure from the top of this pattern down to the neckline, if we do break down from this level, the 200 exponential, the 200 simple, and then also that previous low, the measure move would take us back down here to roughly like 30,600. Now, honestly, that wouldn't necessarily be a bad thing. It would not be great to lose key support levels and obviously for this topping pattern to play out. But the truth is, if we come down to that level and then we just put in a higher low right here, we're still going to have a low, then a high, then a higher low, and then we can go on to potentially enter back into a bull run. So maintaining the 200 exponential and simple is good, but also retesting lower levels for support and then them actually acting as support is very good as well, because it gives potential bulls or bears confidence in the market because we're starting to move back into a potential uptrend. So that being said, it's not crazy to think that we go lower and then actually that's a bullish sign. Also, we could just find support, hold this level, and go higher from here. That would be the simple thing to do because it would be obvious. If we hold support and then we start taking out these previous highs from right here, we're only a few percentage off the top, and more likely than not, we're going to continue on to put in all-time highs. But that being said, now that we are threatening these 200 exponential and simple, some of the other major indices are actually looking worse than the Dow. There's definitely a possibility we break down from here and then actually go on to put in lower lows. So let's pull up our monthly chart. So here we have the Dow Jones on the monthly. Obviously, this thing just goes straight up and to the right. There's been a couple times in history where we've retested the 200 exponential and simple. We actually almost got there in that Rona aggressive dump. But for the most part, this thing stays pretty far away from it. Now, that being said, when we see these spikes where we get further away from the 200s, we tend to have like a reversion to the mean. Even if we don't come all the way back to them right away, we can even go on to make higher highs afterwards. Eventually, we return to somewhere near, if not fair value, which in this case is represented by the 200 exponential moving average and 200 simple moving average on the monthly. So if we just double click and turn our indicators back on and we just kind of have a look at those. So what we're looking for is essentially just trend following indicators. So typically the best times to be in the market are when the TDMACD slope line is blue, and some of the worst times to be in the market or most dangerous are when the TDMACD line is red. So obviously you capture the majority of the gains in blue, and then when it flips red, that's when we have our big dumps. We can also flip red, have a small dump, and then recover quickly. We can also flip red, have almost no dump, and then recover quickly. But we know for sure that when this flips red, that's when we have our aggressive sell-offs. So you got notice back here in 2008 before we sold off massively. You got notice specifically here in 2020 before the Rona dump. And now here we're doing the same thing as well. Now, this dump hasn't been that aggressive, but there are a couple of things to note about it specifically. So we did cross down and turn the 821 bearish temporarily, which obviously is usually followed by more aggressive moves to the downside. While it doesn't have to necessarily continue to the downside, we know that once that red happens, that's when the most aggressive moves happen. So if we're trying to avoid taking big losses, which is obviously the number one priority of this channel, is to not lose your money, because in order to make money, you have to not lose what you already have. So that being said, that is a big danger signal. So when we had this massive bullish candle come in last year in October, we reclaimed the 821, and all of a sudden this didn't start looking so bad. We had another continuation candle afterwards, but then we gave almost all that back. We pushed up again to a lower high, and then we actually gave back all of that as well. So now here we are, we had reclaimed the 821 and crossed the bear cross back green. So it was starting to look good again, but now here we are threatening to cross it back down again. So it seems more likely than not that this was a reflex rally, an attempt to save the trend, and that actually it's failing. Because what we're seeing here is there's some buying coming in, but there's equal or more selling coming in. And we know if that continues over a long enough period, the price will obviously go lower. So when we see a bunch of green histograms like this and then it flips red, that's our warning signs. Once the slope line flips red, that is definitely when we don't want to be in the markets. And then here we see a couple of bounces on the histogram and now a rejection and a couple more red histograms as well. So we're losing that momentum that we started to gain to the upside, and it's starting to roll back over, which tells me that we're going to come down here and likely try to at least retest some of these key support levels, if not retest and put in new lows. Now, if we look at these stochastics here, again, we see the same type of thing. They work extremely well. Obviously, the knife is the best indicator ever made. I am a little bit biased, though, since obviously I made it. But we see the hard sell signal. We exit the bullish control zone. That's potential for a dump. We get the hard sell signal. We exit the bullish control zone. That was the big price action down. We see the hard sell signal. It takes a little time, but then we exit the bullish control zone. Obviously, dump afterwards. So has that already played out? Are we now getting ready to rebound back to the upside? We're actually getting very close to the blue stochastic crossing back above the pink, and that would potentially print us a blue buy signal. So does that mean we should be buying here? Well, there's a possibility, and the truth is we honestly don't know. There's never been so much uncertainty in the markets, and there's a lot of mixed signals right now. So we're off to a new month, and to tell you the truth, we're below all of the major support, with the exception of the 200 exponential and simple. But for me, I think the most important thing to note on this entire chart is the fact that we reclaimed a key level, but we were unable to maintain that. So it's good to reclaim a level, but obviously if you can't hold that level, then it was really just you using up a bunch of energy before the inevitable happens. And in this case, the inevitable being lower prices. Now, again, anything can happen in these markets. We're definitely going to see some exciting price action play out over March. Especially as that will be the end of our first quarter of 2023. And honestly, it's been going by pretty quickly, but it's been nice so far. So we're going to try to keep it up with those gains, making nice trades, and just pay attention to what the market has to say to us. But yeah, I just wanted to talk about the Dow Jones real quick. It's worth paying attention to because that monthly just closed and we did lose the 821 support. So everything that was making me bearish through this area that played out, And then the small bit of bullishness that we had right here as this cross back to the upside is essentially being erased. And while you don't want to be flip-flopping left and right, on a monthly time frame when we start to see this, and there is in fact like a battle taking place right now, it's definitely worth respecting the fact that if these do cross back down to the downside, it takes us exactly back to that same situation where that is the most dangerous time to be involved in the markets. And number one priority is and always will be preservation of capital. You guys know that my strategy is based specifically on avoiding big losses and then letting small wins and small losses cancel each other out. So in the end, we're just left with big gains. And if you've been around for any amount of time, you know we've got some big gains. So yeah, that's it. End of February. I figure with the new candle printing and it being pretty bearish, taking out the last 3 months lows, it's worth note. Obviously, we're losing some key support. I'm not necessarily calling for a massive dump or a bloody waterfall, but I think we should be aware that there's definitely a possibility. So more likely than not, we'll find some temporary support here. A lot of that selling pressure that was coming into the end of the month potentially turn into some short-term buying pressure to start off the month with. But overall, I think now more than ever, we should really be careful of the danger zone. There was a lot of bearishness in the markets as we were melting down here, and then we were able to capitalize on these lows and actually scalp some beautiful trades back to the upside. But the truth is, the markets are extremely bullish again. I'm not seeing that same level of bearish sentiment. I mean, obviously from the perma bears, but not from like normal people. And that is definitely a worrying sign. But yeah, I don't want to go on too long about this. Just worth paying attention to the Dow. Also, we see the same thing from the S&P and the triple Qs. Somehow the Russell actually looks a little bit better, at least for now. So yeah, that's it. Just want to take a quick look at the Dow Jones now that the February monthly has closed and just kind of pay attention to those key levels. All right, see ya.